Question is C 2.1.2. Vikalp Limited provides you the following information for the year ending 31st March 2019. Earning before interest and tax is 28,80,000. Interest on long-term loan 12% debentures is 2,70,000. Interest on debentures issued on 1/8/2018, and the balance sheet given is on, or the information given is on 31st March 2019 is 3,60,000. Earning before tax will be earning before interest and tax minus this interest. Earning before tax will be deducted earning after tax, and there are 6,30,000 equity shares of rupees 10 each. Ruling market price per share is 24. So we are having earning after tax, we are having number of shares, we are having market price. Automatically we can get PE ratio. Undistributed reserves and surplus are 60,50,000. The company needs to raise 30 lakhs for modernization of its plants and has the following options of raising the fund. Option number 1, raise the entire fund by 13% long-term loan, that is only debt of 30 lakhs. Option number 2, raise partly by issue of 75,000 equity shares of 20 per share each, and the balance by 11% debentures. So 75,000 new equity shares will be issued at the rate of 20, which will be 15 lakh rupees, and 11% debt of remaining 15 lakh rupees. Only debt, it is 13% term loan. The company expects the rate of return of the funds employed to be improved by 3% because of modernization, and that if debt equity ratio exceeds 45%, then price earning ratio is go down by 15%. So what they are saying, if your debt equity ratio, that is debt proportion in your company, increases, your risk will increase and your PE ratio, price multiple ratio, will go down. Required if the company is to follow policy of maximizing the market value of equity shares, which option should it consider? We should first find out current capital employed. Why I tell you? From capital employed, we will be getting ROCE, return on capital employed, and it is given in the question that it is improved by 3%. So we will be getting new EBIT from this particular information. What is current capital employed? Of course, there is equity of 6,30,000 equity shares of 10 each. 6,30,000 equity shares of 10 each, which is 63 lakhs. Please understand, reserves and surplus are part of equity, which is 60,50,000. This is 123,50,000. Let us calculate a debt. Now, debt directly is not given, but interest is given. So if you are paying interest of 2,70,000 at a 12% rate of return, your debt will be 2,70,000 divided by 12%, because 2,70,000 is interest for 1 year. Then what is the total amount of debt? 2,70,000 divided by 12%, which will be 22,50,000, which is your 12% debt. Let us go to another debt, which is a 10% debt. Please understand, this debt was issued on 1/8/2018. So how many months interest would have been charged? April, May, June, July. This all months interest would not be charged. So only 8 months interest would be charged. That is 8th month, 9th month, 10th, 11th, 12th, 1st, 2nd and 3rd. So 8-month interest will be charged, which is the 3,60,000. So 3,60,000 is 8 months interest. Then what will be 12 months interest? Because I want what is the loan amount, I'll have to find out what will be 12 months interest, which will be 3,60,000 into 12 divided by 8, which is 5,40,000. So from next year, you are going to pay the interest of 5,40,000 at the rate of 10%. What will be your debt amount or debentures amount is 5,40,000 divided by 10%, which is 54 lakhs. What will be total capital employed? This is 76 lakh 50,000. Total capital employed is debt plus equity. Equity plus debt, 123 1,23,50,000 plus 76,50,000, which is the 2 crore rupees, will be total capital employed. Once we have found out total capital employed, let us find out current R without raising additional capital. What is your current R? What is your EBIT is 28,80,000. Upon total capital employed is 200 lakhs. Multiplied by 100 is your current R or ROCE, 28,80,000 divided by 200 lakhs multiplied by, which is 14.4%. Please understand, this is a current situation. What will be proposed situation? See, current equity and debt are going to remain same, but you will be raising additional capital of 30 lakhs. If you are raising additional capital of 30 lakhs, now your total capital employed will be 2 crore 30 lakhs. And your R, what is your R? 14.4%. But it is proposed that it will increase by 3%. So now it will be 17.4%. Sir, in option 1 and option 2, in both the cases, there will be additional capital of 30 lakhs. So there is no question whether this will be in proposed scheme or present scheme, or it will be in option number 1 or option number 2. Ultimately, if you raise additional capital of 30 lakhs from any source, your total capital employed is going to be 2 crore 30 lakhs. I am finding out my EBIT, which will be 2 crore 30 lakhs multiplied by 17.4%. Return on capital employed, I am having in percentage. ₹40,02,000. So now I know under option 1 what will be total capital employed, what will be EBIT, and I can use my Excel sheet so that I don't have to do some basic calculation. Of course, in examination you will have to do it, but I can use that Excel sheet and find out what will be answer in both the situations. So situation number 1 is 100% debt. what will be total capital employed is 230 lakhs. What will be EBIT is 40 lakh 2000. My ROCE, as it is an Excel sheet, it will calculate automatically, which is 17.40. From total capital employed. Now let us go to option number 1. In option number 1, equity is going to remain same. 1 crore 23 lakh 50,000. 1 crore 23 lakh 50,000. But debt, which was previously 76 lakh 50,000, now there will be increase of 30,000. So total debt will be 1 crore 6 lakh 50,000. So equity will remain 123 50,000. Debt will be remaining, which is 1 crore 6 lakh 50,000. Taxes are given in the question, which is 30%. And cost of debt. Now, here I am not directly doing cost of debt. I am finding out interest because all are having separate rates. Let me find out interest separately. My interest in these two cases from next year, understand this is a proposed situation. I will be paying my total interest and not only interest on this. So I am going to pay interest of this 2,70,000. I'm still in option number 1. Interest on that 12% loan is 2,70,000. In 10% loan, 5,40,000. In last year, it was 8%, 8 months. Now, from now onwards, it will be 12 months. And a new loan of 13%, 30 lakhs. Which is 3,90,000. So this will be my total interest in option number 1, which will be 2,70,000 plus 5,40,000 plus 3,90,000. That will be 12 lakh rupees. So let me put interest over here. There is EBIT 40 lakh 2,000 minus interest 1 crore 12 lakh rupees. Earning before interest and tax will be 28 lakh 2,000. Taxes are deducted at the rate of 30%. Earning after tax, I am getting it. Let me find out number of shares. There is no change in number of shares. It will remain as it is because the additional capital is debt in option number 1. So number of equity shares will remain 6,30,000. So I am getting EPS. What will be scenario of my PE ratio? I'll be doing last. Let me first do situation number 2. In situation number 2, my total capital employed is 2 crore 30 lakhs. But now we are issuing some equity. What is current scenario? Equity of 1 crore 23 lakh 50,000 plus there is an addition of equity plus reserves. Understand, if you issue a 10 rupees share at 20 rupees, 10 rupees will go in equity share capital and 10 rupees will go in reserves and surplus. But here we are not concentrating on how much will go in equity share capital, how much will go in reserves. We are understanding that everything is nothing but equity. So how much equity you are raising? 15 lakh rupees. 7,50,000 will be equity share capital, 7,50,000 will be security premium, but total will be 15 lakhs rupees. So equity will totally increase by 15 lakh rupees. This will be 1 crore 38 lakh 50,000. And debt. Now debt is also not remaining same. Debt currently was 76 lakh 50,000, which will increase by 15%. 15% of 15 lakh rupees. Which is 91 lakh 50,000. Total will be total capital employed, which we have already calculated, but let me put in those figures. So total capital employed is 2 crore 30 lakhs, out of which equity is 138.50. And so debt should be 9150. ROCE is remaining same, so my EBIT will remain same. Taxes are 30%. Cost of debt, interest I'll have to find out separately. Interest in this particular case will be, I will be paying this interest, this interest. So 2,70,000 plus 5,40,000 will remain same. But new debt of 15 lakhs is of 15%. 15%, 15 lakhs rupees debt, which is 2,25,000. Total will be 10,35,000. So interest will be 10,35,000. Everything else will be automatically calculated, but I'll have to go through to number of shares. Please understand, previously there were 6,30,000 shares. 6,30,000 shares. How many new shares are issued? It is clearly given. 75,000 equity shares will be issued at 20 per share. But sir, 75,000 shares of 10 rupees is only 7,50,000. No, they are issued at 20 rupees. But you will have to issue only 75,000 new shares. So there will be addition of 75,000 more shares. So now new number of shares will be 7,05,000. I will be getting answer of EPS. Now everything is dependent upon PE ratio. What is the current PE ratio? Please try to understand. My market price is 24. Where my earning per share, which is 15,75,000 divided by 6,30,000. 15,75,000 divided by 6,30,000, which is 2.5. So my PE ratio is MPS divided by EPS, which is 24 divided by 2.5. 24 divided by 2.5 will be 9.6. So what is my current PE ratio? Current PE ratio is 9.6. Now, what does they say? Please try to understand. In option number 1, what is my debt upon debt plus equity. My debt is 1 crore 6 lakh 50,000 divided by debt plus equity will be total capital employed, which will be 2 crore 30 lakhs. So in percentage terms, how much this is? What is the debt proportion in total capital employed? That is what they mean to say. I can directly get it from Excel sheet also. The debt proportion is 46.30 in total capital employed, which is 100. So I'm having this formula. You can just find out the answer, which will be 46.30. And what it says, please try to understand. The question says if debt upon debt plus equity exceeds 45%, does it exceeds 45%? Yes. Then my PE ratio will go down by 15%. So what will be my PE ratio in option number 1? PE ratio in option number 1. What is current PE ratio? Is 9.6. In option number 1, that particular ratio is exceeding 45%. So PE ratio will go down by 15%. 9.6 minus 15%. 8.16. So in option number 1, my PE ratio will be 8.16. I will be getting MPS. How to find out MPS? EPS multiplied by PE ratio. Why? PE ratio is nothing but MPS divided by EPS. So MPS will be nothing but EPS multiplied by PE ratio, which is 25.4048. Let me find out PE ratio in option number 2. What is debt upon debt plus equity in option number 2, which is 39.78%. (39.78% is the debt upon debt plus equity, which is total capital employed multiplied by 100, which is less than 45%. So my PE ratio will not change and it will remain same at 9.6. So here my PE ratio will not be 8.16, it will be 9.6. And so my market price of per share will also change. This is nothing but answer of option number 1 and option number 2. Your objective is to maximize MPS. MPS in situation number 2, debt plus equity, is higher, and so we will be selecting option 2, which is raising 15 lakhs rupees as debt and 15 lakh rupees as equity. Let us invest 2 minutes and even understand the answer. We all know trading on equity. As we increase the debt proportion in our capital structure, the company's value or earning EPS should increase. If R is greater than KD, what is R? It is 17.40. Sir, what is cost of debt? Now, cost of debt is 11%, 12%, 15%, 10%, whatever it is. But R in any case is greater than KD. So, sir, R is greater than KD. Agreed. There is a favorable leverage. And so, you should go for a risky plan, not always try to understand. In situation number 1, it is a risky plan. You will see that your earning per share is 3.11 And in option number 2 it is only 2.94. So EPS in plan number 1 is higher. Our trading on equity will always work. If there is a favorable leverage, your EPS will be higher in a higher risky plan. But what is happening in this case is that the risk of the company is increasing because you are increasing the debt proportion, and so your equity shareholder came to know that you have increased the risk, so they have reduced the PE ratio. Your PE ratio is reduced by 15%, which became 8.16. And because of that, your MPS comparatively is lower in plan number 1. Believe me, if there was no change in PE ratio, let me take PE ratio 9.6 over here. 9.6 over here. Believe me, answer in situation number 1 will be higher if the PE ratio remains constant. But because there is a change in PE ratio, answer in option number 2, MPS in option number 2 is higher because in option number 1 PE ratio is reduced. So all of you are getting it. R is greater than KD. There is a favorable leverage, and so EPS in a risky plan is higher. But because of PE ratio, MPS is not higher in risky plan. This is what should be the understanding. Just solving the question is not important. You should also get an idea why the trading on equity or leverage effect is not working in this particular situation.